Okay, so today we want to look at, let me see, let me just share. Okay, so today we want to look at the Fibonacci. We want to look at the Fibonacci, and then I'll give my insights to how you can effectively use it when you are like trading. So for sure, to just say Fib levels and strategy. So this is the Fibonacci. I can go into my settings. Yeah, so you can pause the video and copy my settings, these ones. These are my settings. You can pause and then take like a screenshot and then use these settings. If you're done, then we'll leave it at that. But before I even continue with this, let me just go back a little bit. So we're looking at fib levels and the strategy that we'll be using. So if you remember very well, in one of my videos for market structure, we said that the market always moves in impulses and retracements. So it moves like that. So your job when you're using the fib is simply to identify where these retracements or turning points are likely to occur. Now we said, quick recap, we said that this usually happens on the 50 to 61.8 fib levels. That's where this occurs. So now, if I was to use this Fibonacci, I want you to pay attention to the numbers. I start exactly at the bottom of this impulsive move there. Then I move this all the way to that level. So I want you to pay particular attention to the numbers now. You notice that this here, the highest point before that retracement is on the level 0.00%. This here, the beginning, is exactly on 100. And then the retracement usually occurs on this level here. That level is called the golden ratio. It's the 50% to 61.8%. So that's where most of the retracements tends from. So meaning, if you have, by the way, a Fibonacci can only be used in uptrends or downtrends. In short, it can only be used in trending markets. Ranging markets, it won't be of any help. So it's only used in trending markets, either an uptrend or a downtrend. Then you only trade if the market reaches this level here, the one I'm talking about, the golden ratio. At times, even the 78.6 is also a turning point. But remember, that means the trend is not very strong. So your exit shouldn't be any of these extension levels. Because it means if the retracement went in very deep, it means that the sellers are now gaining momentum, hence might change the direction of the market. I think I've said a lot. So now let me remove this. So that's about the Fibonacci. Now let's try it on a live market. So you've seen like this market, for instance, here. What you want to do is you want to ensure that when you get your Fibonacci, you are touching the tip, which is this. Or if you want, you can change this to a line chart so that you can see what I'm saying. You want to touch the bottom part, which is this, all the way to that highest point it had reached before it turned. Now you have that level there. Now you can see that once the market went right up from this, it had this strong impulsive move, then there was this move down and it turned exactly at 50 going upwards. So at times this doesn't work. It doesn't work to like reach this level again, because remember, sometimes it means the market has been like overbought or oversold, so it can't continue going further up or further down. So that's why this didn't push all the way to that level. So then as a smart trader, what you're supposed to do, as the market starts going in your direction, you start moving your stop loss so that you lock in some profits. So this is how you use the Fibonacci. You've seen here what it's touching, it's only the candles, even there on top, it's only the candles. It has ignored the wicks. So you can either use that, or if you want, by the way, let me just zoom in so that I show you what I mean. You see, if you pay close attention to this level here, see this line for the Fibonacci is only touching the candles, the body of these candles, leaving out that wick. Then at the bottom here, it's also leaving out this wick. You can see there's this wick down. It's only reaching where the bodies are. So you can either use that, or if you like, you can come do this. You can ensure that you touch both wicks. So if we're going to use the wicks, we'll say from this bottom wick all the way to that upper wick. Then I just move this. It can work. And I think this one is easier because trying to focus on the bodies can be challenging if you're new. So would rather use the wicks. So then this becomes our entry zone, this level here. Whenever the market comes back to this area, we'll be looking for buys. But then remember, we're not trading this in isolation. We're using other confluences as well to help give more reasons as to why we should enter the trade. Then the next thing we want to look at is how it applies in a downtrend. So let's find the downtrend. Should have something. Let's find the downtrend and see how it applies. Let me see, can it work? Yeah, I'm trying to just give an example that will be very easy to understand. Yeah, I think this works fine. Let me just zoom in now. So we're in a downtrend. This is a downtrend. The market is moving downwards. Characteristics or traits of a downtrend, you can watch my video on market structure. I explained that in details. So here what we want to do is we want to pick this point here all the way to this level. that level there. Now you notice that the markets are supposed to retrace within that area. That's where our golden ratio is. So once the market pushed all the way back to this level, it dropped downwards. Now you can see, you'll notice that here I have extension levels. There's this negative 27 and this negative 61.8. So now these extension levels mean that if a certain trend is very strong in either direction, either it's an uptrend or downtrend, if the trend is very strong, it means that chances are it's going to reach this extension level. Then if it's not very strong, at least it will reach this extension level. Then if it's not so strong, you expect it to at least come back to this level. What I mean is, like what we were looking at earlier, it never reached this level. That means that the trend wasn't very strong. So that's about the extension levels. Extension levels just give you where you should put your take profit and where you should put your stop loss. Sorry, take profit only for the extension levels. Then after the golden ratio, that's where you get where to put your stop loss. Now what that means is this. For instance, if I was to take this trade, here's my thought process on this. So I'll say, since it's a short, starting from after I've seen that, I'll put my stop loss right there, just above my golden ratio. Then I'll put my first take profit on this level. Then my second take profit will be right there. And I can just reduce my stop loss a little bit because it's too wide. I just need to put it just right above, okay, just right above this area. Because I'm assuming that if this trend is very strong, there's no way this market is going to break this level because it was previously a resistance level, which has now tended to support. No, it's still a resistance level. It's still a resistance level. You can see from these two here, from these 2 points there, that one and this one. From those two levels, it is a resistance level. Hence, I expect it to be a very strong area. So that's also a confluence I have. It's a resistance area. The market has formed a fib level. The golden ratio just right around that level. So then what I'll be expecting here is this. Since the market goes back to this area, I'll be particularly looking at the candles here and what's going on. Once I see that, I get a candlestick confirmation, like a bearish engulfing candle, you have evening stars, all those types. A tweezer top, I'll be looking for that. Then once I see them, I enter my trades and expect the market to drop all the way to that level. It's as simple as that. So then, take profit areas. Remember, if you have a very strong trend, this becomes your, or maybe let me write that down. So here, that's your TP2, and then copy, paste this. This would be TP1. stop loss will be just right above that area. Stop loss, I'll just say SP. SL. That's your stop loss. So this is how we use the extension levels. If a trend is very strong, your TPs should be on the extension levels. And how you can figure out if a trend is very strong, I explained it in depth on my video on market structure. Just watch that video. It explains step by step how you can identify strong trends. So that's about the Fibonacci. The next thing that you're supposed to pay attention to is precision. I think I've already touched on this. Precision. So precision just means you ensure that when you get your Fibonacci here, you start exactly at the topmost of this wick. That then when you drag this, you're not just going to put this anywhere. You want to ensure that you put it on the longest wick you can see, which is that one in our case. That label there. Then you drag your levels so that you give yourself room. Now you can see. You want to ensure that you are using precision here. You're not just going to drag this Fibonacci anywhere on this chart. Because if you do that, it means your entries will be very poor. Here, what you want to do is to ensure that you work on your precision or accuracy of this. Yeah, so I've talked about the golden ratio. I've talked about precision. I've talked about how to use it in an uptrend, downtrend. I've talked about where to put your stop loss. I've talked about where to put your take profits. I've also looked at the fib in gen. I've looked at the fib in general. So I think this is probably an example of that 70% level, the one I was talking about earlier. So if I was to extend this. So you can see this market turned in this 78.6 level. So this is also another level where the market can turn from. You can see there was that upward push, then it dropped back to this golden ratio. Then from there, we had this push up all the way to the -27 extension level. So since this wasn't a very strong trend, it never reached our 60. Can't even see. Oh yeah, it's there. Our -61.8, because it was a very, very weak trend. It wasn't that strong. You can see there was this downward push, then that upward push. So you can use this on anything as long as it's in a trend. Remember, you only use the fib on trending markets. So you can use this almost anywhere. You can see the fib is almost anywhere. And if you can't see here, what you do is, the trick is just change these candles to a line chart like this. Now you'll be able to see that that's your highest point. Then this is your lowest point. Then the market is expected to turn around that area. Then if I was to move back to candles, you'll notice that. Oh, by the way, I think I mentioned this earlier, but let me just emphasize. So whenever you're using line charts, it ignores the wicks. So you can see on this level, it ignores the wicks, even here. And that's fine because it touches the bodies of the candles with high accuracy, more than you can just by looking. So that's fine. If you've used line charts, then it takes you to this. Or if you want, you can just remove this and just draw this yourself if you're able to see clearly. Let me just remove this. Able to see, so you just say that highest point till all the way to that low wick there. Now, here's our turning point. We're expecting the market to turn from that level. And that's what happened. Then this was a strong trend. You can see that it reached all the way to that level. So remember, you put a line here. That's where you're expecting a turning point. Then if you want to take this trade, you enter from here. That's after that evening star. Then you want to put your stop loss right above that. Then your take profit should be at this level. That's your TP1. Then your TP2 should be all the way to that level. Then you should be closing as the market is going in your direction. Now remember, you're not using the Fibonacci in isolation. You're using it accompanied with other confluences. Then there are two ways of thinking about the Fibonacci. So you can trade short-term trends or long-term trends. What I mean is this. I have something I call broad thinking and impulsive thinking. So if I was to go all the way to here, so when I talk about broad thinking, what I just mean is you like ignore these short term. So let me just see if it can work here. So if I was to move back to line chart, here's what I mean. It's like you ignore these small Fibonacci levels that it's making within this broad. Okay, no, let me do this to make this a little bit clear. Let me do this. Let me just come here and then explain it. Then we'll look at it on the chart. What I mean is this: if the market is moving like this, right? It's making higher highs and higher lows. I'm going to assume that's the market moving. Within these moves, it has smaller, more like fib levels as well, like that. Hope this makes sense. Within that main trend, it has smaller trends as well. So now what I'm saying is you ignore the small trends, this one, the one I've just put, and you only focus on the higher levels that you can definitely see with your eyes, with your naked eyes. When you just turn the candlestick chart into a line chart, the ones that stand out to you, those ones, you just draw those levels. Once you do, that's called broad thinking. Impulsive thinking is where you're just trading these smaller impulses. It works on both. So it just depends with what you want. So now let's go back to what we were looking at. What was it? Let's see. Did I remove it? I probably did. Okay. So what I was talking about is just by looking at this, I start from here, right? All the way to that level. I was to zoom in that. What I've done here, someone else can say, for context sake, let me just remove this. Some people can just trade that. So out of this bigger Fibonacci, the one I had drawn in, there are also these smaller ones. So let me just zoom in so that you see what I'm looking at. Seen, right? There was that impulsive move, then there's this minor drop, then that push all the way up. There are people trade things like that, targeting 5 pips, 6, 7, 8, 10, all that. But then the most profitable one, at least for me, is targeting. Let me try to reduce this. Targeting the bigger move. In short, using broad thinking. Instead of trying to like squeeze that 5 pips or whatsoever, I would rather target this one. Where I know that once the market reaches my zone, this level, what I want to do is I want to put my entry right above that. In the next video, I'll explain more on candlesticks. And my TP1 is there. So this would have been my thought process here. I put my take profit right below this golden ratio. Sorry, my stop loss. Then my take profit is on the second extension level. But I'll close some partial profit the moment the market reaches this. The reason being is because if you see on your left, we had a lot of resistance. The market tried several times here to break this level, but it kept failing. It kept failing to go past that level. So what I want to do is, I want to ensure that once it reaches here, chances are it might fail again to break that level. So I want to take some partial profits the moment it reaches this level. Because remember, we're in trading to make money, so it doesn't matter how you do it, as long as you're able to make money. I have no problem with it. So that's how we use the Fibonacci. Also, this here is another trade I probably missed. Should have seen this early. So I have this point. If I push this all the way to that level, you notice that this fits in perfectly with our Fibonacci. Now remember, you're not just going to be using the Fibonacci in isolation. You need to also have other confluences that support your analysis. Now those can be things like fundamentals, you can have supported resistance levels and the like. So at this level here, you can see this is let me see. Yeah, this looks like it was somehow some previous support area. If I was to extend this, you notice that this was some previous support area. So now this makes this even more accurate. And you can see this pushed all the way to our extension level. So that means it has hit our TP2. Then your stop loss has to be somewhere close to this 78.6 level. Then you need to wait for some candlestick confirmation here. Like this harami pattern, you can see from there. That's pushing this upwards. So this is how you use the Fibonacci, the easiest way to make money on the market, just by using Fibonacci and a few other confluences. Let's see. Is there anything that I've left out? So we've talked about extension levels. I've said the extension levels just help you to identify where you should put your take profit. So by extension, let me just be showing you this so that you're seeing what I'm talking about. Oh no, let me do this to make it easier. Let me just draw a quick. So you're putting things in perspective as I'm talking. So you have this, that's your start, all the way to that level. Now zooming this to the right. You might ask, why am I doing that? The reason is simple. You don't want these numbers to be disturbing what you're actually doing here. So then remember, these are not lines, they're areas. So that's why I always use that rectangle. I have this area here. That's where the market is standing from. So then the extension levels I'm talking about are these one. This is an extension level. This is an extension level. Now, what's the importance of these two? These two help you identify the most likely levels the market is going to reach if the trend is very strong. And I explained in the market structure video how you can identify if a trend is strong or not. Next, this level here, this level gives you an area to take partial profit. So that level, because you will notice that before the market turns, it means there's strong resistance on that level. So once it turns, chances are when it gets back to that level, it might face some resistance, hence maybe causing it to drop at times. And it forms that double top. So that means once it reaches this level, chances are the resistance might be very strong, causing the market to go down. So that's why this level, that's why you take some partial profits. Then if the market breaks all these three levels and goes down, it means you are wrong in your analysis. Hence, you want to keep your losses very small compared to your wins. So that's why you just put your stop loss just right below. If the market stand very close to this 78.6, you just put it right below that same level, because you don't want to be taken out premature in your trade. So what I mean is, if I was to take this trade, let's say I've entered from there, I would definitely put my stop loss right there, just close to this 100% level. Then my first partial profit to be taken here. Then if this is strong, it means that my TP1 will be here on this first extension level. My TP2 will be on that negative 61.8%. That's my thought process whenever I'm trading using the Fibonacci. I hope this helps. If you have any questions, you can leave them down in the comment section, and then I'll look at them and get back to you shortly. Enjoy your day, and don't forget to subscribe. share and like. Thank you for your time.